Morningstar's monthly analysis of inflows into Europe-domiciled open-end funds and ETFs shows that investors increased their exposures to equity and riskiest bond funds in June. Long-term funds continue to attract net new money for the third month running, pulling in 63 billion euros, the highest level of inflows seen in 1 month period since February. Fixed income funds continue to attract the highest inflows, gathering 37 billion euros last month. Meanwhile, equity funds took in 19 billion. Allocation products showed an impressive comeback, pulling in 10 billion, the highest level of monthly inflows since February 2018. As fears of a global recession receded, inflows to commodity funds slowed down considerably in June. Thanks mainly to huge inflows sent to gold ETCs, commodity products posted record-breaking inflows of 14 billion in the first half of the year. Money market funds continue to see high demand, gathering 45 billion euros in June, an indicator that some investors are probably waiting for less uncertain times. Overall, the extensive monetary and fiscal support measures by central banks and governments worldwide have heartened investors who still appear confident that the economy will rise from the doldrums in a V-shaped recovery. This is reflected by the inflows of 164 billion euros that investors sent to the European fund market in the second quarter. Those inflows more than compensated the outflows seen in the fourth quarter. A look at the top-selling categories of the month reveals a strong demand for corporate bond funds, attracting 5.6 billion euros of net inflows in June, followed by global large-cap growth funds and equity technology products. On the other hand, alternative multi-strategy funds continue to bleed. For the year-to-date, these hedge fund mimicking strategies have suffered outflows of 13 billion. Finally, energy funds, mostly ETPs, suffered a collective withdrawal to take profit after the massive inflows seen in April and May, when investors were betting of oil price increasing.